Hello everyone. In this chapter, we will discuss valuing stocks. So when we use the concept of present value to price common stocks, we are not promising a key to investment success. We simply believe that the idea that can help you to understand why some investments are priced higher than others. Now, you can have a question in your mind that why do we need to find out the value of a common stock? If a common stock is traded in the market, I mean stock market, we can simply look at the financial newspapers about the price. So why do we care about finding out the price of a stock? Well, if you want to know the value of a firm's stock, you can simply look at newspaper. Unfortunately, that's not always possible. For example, you may be the founder of a successful business. You currently own all the shares but are thinking of going public by selling of shares to other investors. You and your advisors need to estimate the price at which those shares can be sold. There is also another deeper reason why managers need to understand how shares are valued. If a firm acts in its shareholders' interest, it should accept those investments that increase the value of their stake in the firm. But in order to do this, it is necessary to understand what determines the share's value. Well, we begin with a look at how stocks are traded. Then we explain the basic principles of share valuation and the use of discounted cash flow models to estimate expected rates of return. So in this chapter, we will find out how to value a common stock, and we will apply present value formulas for valuing common stock. We will see the relationship between stock prices, earnings, and growth opportunities, and we will also learn the process of estimating cost of equity. So first, we will learn these concepts, primary market and secondary market. You know that stock markets are classified into these two, primary and secondary market. Primary market is the market for newly issued securities. For example, government issues treasury securities or a corporation issues common stock, then these are primary market transactions. Secondary market, on the other hand, a market for existing securities. There is one key difference between primary and secondary market is primary market supplies the fund from an investor to the issuer of securities. For example, if you buy a newly issued common stock from primary market, this fund will be supplied from you as an investor to the company, the issuer of the securities. On the other hand, secondary market provides liquidity to existing securities. It does not supply fund from investor to issuer. Rather, it transfers fund from one investor to another when investors keep buying and selling securities in the secondary market. Common stock is the ownership representation of a company that's being traded in the stock market. Or you can say the common stock represents a part of the ownership of a company. We will be discussing more detail about different types of stocks in some future weeks. Some more terms, book value and market value. You know that book values of a stock are actually the value of the stocks that are represented in the balance sheet of a company. Okay, and book value of a firm, when we say, is the net worth of the firm according to balance sheet. If you can remember of a balance sheet, what we have is assets, liabilities, and equities. Okay, so the difference between assets and liabilities and equities is called the net worth. So which is the book value of a firm. Dividend, on the other hand, is the part of the profit that is distributed to shareholders, and part of the profit that is retained with the firm is known as retained earnings. Price earning ratio, probably the most commonly used indicator by the investor whether they should invest in a stock or not. So price earning ratio is the current market price divided by the earning per share. So a higher price earning ratio generally indicates an overpriced stock. So investors try to avoid that. On the other hand, a lower price earning ratio may indicate that the stock is underpriced and investor may consider buying that. And market value balance sheet is basically the represents the market value of the assets and liabilities of a company. You will typically see this information of a company in the financial newspaper. For example, this is General Electric, common stock. This is the previous closing price. This is the opening price. Uh, this is the days range. I mean, the prices between which the days transaction took place. 52-week range is the lowest and highest price of this stock in the last 1 year. Volume is the number of shares traded, and this is average volume. Market cap is the number of shares multiplied by the share price. This is the price earning ratio. This is the earning per share, and this is dividend yield. These are the indicators of whether we should invest in a stock or not compared to some benchmarks. Now, how do we find out the value of a stock? Well, the concept of valuing a stock is the same as the present value of a stock should be the present value of future cash flows to be generated by a stock. Now, what cash flows a stock generates? Dividends. So the present value of a stock will be the present value of future expected dividends. You can see in the slide. So present value of a stock is the present value of future expected dividends. Now, to find out the present value, we need a discount rate that represents the required rate of return of investor or cost of capital, which is also sometimes known as market capitalization rate. Now, this is how we calculate expected rates of return. And to calculate rate of return, we still use the same concept we previously learned, that a rate of return is the income from an investment divided by initial investment. So if we invest in a stock, for example, the income comes in the form of dividend and also in the form of price change. So this is the dividend, this is price change, and as we divide by initial investment, so what we get is the rate of return. So look at this example. If Fledgling Electronics is selling at $100 per share and expected to sell 110 1 year from now, what is the expected return if the dividend 1 year from now is forecasted to be $5? So if we invest in this share, we need an investment of $100. And what are the income we expect to receive? $5 in the form of dividend and $10 in the form of capital gain. You can see we invest $100 and we expect the price to be 110. So the price difference is $10. This return is called capital gain. So this is dividend, this is capital gain. As we sum them up and divide by our initial investment, so our rate of return on this investment will be 15%. Now, how do we calculate the value of a stock? As I already said, the value of a stock will be the present value of all future dividends. Now, if we expect to hold the stock for a particular time period, let's say you buy a stock now and you want to sell it after 1 year, then how do you calculate the value of a stock? You should calculate the value of a stock as the present value of the dividend that you expect to receive next year and the price at which you expect to sell the stock at the end of year 1. So here you can see the price of a stock is the dividend that you expect to receive in year 1 and the price at which you expect to sell it at year 1 divided by 1 plus discount rate. So here is the example. Fledgling Electronics price can be thought of as follows. The present value equals to, this is the dividend we expect to receive, and this is the price at which we expect to sell the stock. We divide it by 1 plus the discount rate. So the value of the, I mean, it's called the theoretical value. The theoretical value of the stock is $100. Now, this market capitalization rate can also be estimated using the perpetuity formula that we learned in week 2. And this is also known as I previously mentioned, is the cost of capital. So cost of capital is also known as market capitalization rate. So this is the formula. Price of a stock is dividend divided by R minus G. I hope you are familiar with this formula. In week 2, we have seen the perpetuity is the cash flow divided by the required rate of return. So when we have a growth rate, so this is basically the growing perpetuity. So dividend at year 1 divided by R minus G. So we are expecting the dividend will grow at a constant rate. Now, if we rearrange this formula and we bring R in the left-hand side, so we get this equation, dividend in year 1 divided by P0 plus G. So this R is the required rate of return or cost of capital or market capitalization rate. Now, this is a more formal model of estimating the value of a stock. So this is the value of a stock. We expect to hold this stock for a certain time period. So this is the dividend until that period, and this is the price of the stock when we sell it. So these are the discount rates as we discount all the dividends and the price at the end of certain period, we get the value of the stock. Okay, so these are the present value of all dividends, and this is the price at which we expect to sell after the certain time, and 1 divided by R power H is, so this part is the present value of the price and this part is the present value of dividends, and this is the value of the stock. So you can see that the formula is pretty much similar to that of the value of a bond that we learned in chapter 3. So in chapter 3, this was the present value of interest. Now it's the present value of dividend. And this part was the present value of principal payment. However, this part is the present value of the price at which we expect to sell the stock. Look at this example. Fledgling Electronics is forecasted to pay a $5 dividend at the end of year 1 and 5.5 dividend at the end of year 2. At the end of the second year, the stock will be sold for 121. So if the discount rate is 15%, what's the price of the stock? So theoretically, this $5 and $5.5 is the dividend in year 1 and year 2, and 121 is the selling price. So we would find out the present value of all these three cash flows to get the value of the stock. So this is $5, this is 5.5 plus 121, because both of these cash flows come at the end of year 2. So as we find out the present value of these cash flows, we get $100, which is the value of the stock. Once again, the theoretical value of the stock. So here is another example. Current forecasts are for XYZ company to pay dividends of $3, 3.24, and 3.50 over the next 3 years respectively. At the end of 3 years, you anticipate selling your stock at a market price of 94.48. What's the price of the stock given at a 12% expected return? So once again, we use the same concept, just we have 3-year cash flows now. So as you can see, these 3.24, and 3.50, these are the 3 dividends we expect in year 1, year 2, and year 3. And 94.48 is the price we expect to sell the stock at the end of year 3. So once again, we find out the present value of all these cash flows, we sum them up, and we get the value of the stock is $75. Okay, now how this value helps us in making an investment in stock. As I already said, that this is our theoretical price. We compare this price with the current market price. Okay, so if we see that current market price is less than this theoretical price, then the stock will be underpriced. The stock will be called underpriced, so we will buy it. On the other hand, if we see that current market price is greater than this theoretical price, it means that the stock is considered overpriced, so we wouldn't buy it. We should sell if we currently hold this stock. So this is valuing non-constant growth. So far we have seen that a stock is paying dividend for a certain number of years, and we expect to sell the stock at the end of that period, and we find out the present value of dividends and price. Now, what if we expect to hold a stock for an indefinite period? Okay, in that case, what we do is we find out the present value of the dividends up to a certain period. Then we assume that the dividend will be either a perpetuity or a growing perpetuity. Okay, so we find out the present value of that perpetual or growing perpetual cash flow, and we find out the present value of dividends to get the value of the stock. So look at this example here. Phoenix produces dividends in the 3 consecutive years of 0.31 and 0.65 respectively. The dividend in year 4 is estimated to be 0.67 and should grow in perpetuity at 4%. Given a discount rate of 10%, what is the price of the stock? So these are the 3 dividends and we find out the present value. That's fine. But in year 4, the dividend is expected to be 0.67 and which is expected to grow 4%. Okay, so you can see that here the stock becomes a growing perpetuity. Stock's dividend becomes a growing perpetuity. So this is dividend divided by required rate of return minus G. Is that all right? And so this part is the perpetuity and we multiply it by the present value factor. So this part is the present value of the growing perpetuity from year 4 onwards. That means at the end of year 3 onwards. So this is the present value of the dividends up to year 3 and this is the present value of the growing perpetuity at the end of year 3. And we sum them up to get the present value, which is 9.13. So this is the end of our discussion on valuing common stock. So please watch the next video to understand the discussion on cost of equity capital.